In 1929, the U.S. stock market imploded, dragging the nation into the Great Depression. Stocks lost nearly 90% of their value over 3 years. Unemployment soared to 25%. Banks collapsed. Life savings vanished. It took a quarter of a century for markets to climb back to their 1929 highs. Then came 2008. The housing bubble burst, setting off the Great Recession. Stocks plunged 57% in just 18 months. Unemployment hit double digits. Banks needed government lifelines. Retirement funds were shattered. Recovery took 5 long years. But 2025 is different. This time, it's not just stocks, it's everything. Stocks, bonds, and real estate are all falling together in what economists now call the everything bubble. And when all assets collapse at once, there's nowhere left to run. What if this isn't a new story at all? What if we're reliving 1928, right before the Great Depression, only worse? Because the safety nets that once saved us no longer exist. The Federal Reserve can't cut interest rates to zero. They're already too low. It can't print endless money again. The last round sparked the worst inflation in 40 years. And the government can't bail out the system. It's already buried under $36 trillion of debt. Every major warning light is flashing red. The risk window between November 2025 and June 2026 could trigger the most destructive wealth wipeout in modern history. This isn't guesswork. It's arithmetic. To see why 2025 stands apart, you need to understand that this isn't a single bubble. It's 3 historic bubbles, all inflating and bursting at the same time. Let's start with stocks. The S&P 500 now trades at nearly 28 times earnings, almost double its long-term average of around 15. This kind of overvaluation has only appeared twice before. In 1929, before the Great Depression, and in 2000, before the dot-com collapse that erased 78% of the Nasdaq's value. Both times, the crash followed within months. But 2025 is even more dangerous because of extreme concentration risk. Just 7 tech giants, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up almost 30% of the entire S&P 500's market value. If they fall, they drag the whole market down. The last time this kind of imbalance existed was 1929, when a few industrial giants held up the market before everything crumbled. Even in 2000, tech stocks weren't this dominant. Today's concentration is unprecedented and dangerously fragile. Nvidia is the clearest symbol of the mania. Its stock trades at over 65 times earnings, meaning investors are paying $65 for every $1 of profit. Its total value now exceeds $3 trillion, more than the entire German stock market. That's not rational pricing. That is speculation, fueled by the AI boom, just as 1999's bubble was driven by internet hype. Back then, everyone believed the internet would change the world, and they were right. But they were disastrously wrong about how fast profits would follow. The same delusion is happening now with artificial intelligence. Next comes real estate. The housing market is even more inflated than it was in 2008. As of late 2025, home prices sit roughly 50% above their long-term average relative to income and rent. In 2008, that figure was only 35%. That means this bubble is roughly 43% larger than the one that caused the Great Recession. The crash that nearly ended modern capitalism came from 35% overvaluation. Today, we're at 50%. Yet people think it's normal because inflated prices have lasted so long. And residential housing isn't the only problem. Commercial real estate is quietly imploding. Office towers are empty. Vacancy rates are hitting record highs to 45% nationwide, 35% in cities like San Francisco. These properties were financed when rates were around 3%. Now, Those loans must be refinanced at 7% to 9%. The math doesn't work. Defaults are coming, triggering bank losses and a chain reaction eerily similar to the 2008 subprime crisis, except this time in office buildings. Then comes the third and deadliest bubble, the bond market. Traditionally, bonds protect investors when stocks fall. In 1929, they held steady. In 2008, treasuries soared while stocks crashed. But in 2025, bonds are plunging too. Why? Because the U.S. government has issued so much debt that the market simply can't absorb it anymore. Federal debt now exceeds $36 trillion, about 125% of the nation's GDP. That's the same ratio America had after World War II. Except then, the country stood alone as the world's industrial superpower. Now, it's competing with nations carrying less debt and stronger balance sheets. The annual interest bill on that debt has exploded past $1.2 trillion, larger than defense spending, larger than Social Security. When interest payments become your biggest expense, you have only three options: slash spending and risk recession, raise taxes and choke growth, or print money and ignite inflation. Every path leads to crisis. This is why 2025 is called the everything bubble. Stocks are overpriced at levels seen only before historic crashes. Real estate is in a worse bubble than 2008, and bonds, the supposed safe haven, are collapsing under the weight of impossible debt. The resemblance between 1929 and 2025 isn't just historical, it's mathematical. Back then, valuations reached extremes no one had ever seen. Now they've returned. In 1929, new technologies like electricity and automobiles made investors believe the old rules no longer applied. In 2025, artificial intelligence is playing the same role. By 2024, cracks in commercial real estate were impossible to ignore. When major investors in Los Angeles defaulted on 2 office towers, the world noticed. Even Blackstone, the largest property owner on Earth, faced massive redemption requests as investors rushed to pull their money out. These aren't to beginners. These are the experts walking away because the math no longer works at today's interest rates. When the smartest players start abandoning ship, it's not panic, it's recognition that the system is breaking. And as more commercial loans come due in 2025 and 2026, the defaults will multiply, triggering bank losses, foreclosures, and failures across the system. The next crash won't arrive with a siren or headline. It will start quietly. Maybe a disappointing tech earnings report, a mid-sized bank failure, a debt ceiling fight, or a geopolitical flare-up. The spark won't matter. The structure is already soaked in gasoline. Once one piece falls, the rest follow. If Nvidia or another of the Magnificent Seven disappoints investors, automated trading will react instantly, selling everything in sight. A 10% to 15% drop in one day is all it takes to ignite fear. Since Nvidia alone represents nearly 7% of the S&P 500, that single fall could drag the whole index down. Once confidence breaks, the other tech titans, Apple, Microsoft, Amazon, Google, Meta, Tesla, will follow. A 20 to 30% plunge across the Magnificent Seven would mean a 6 to 9% drop for the entire market in days. Then come margin calls, the accelerant that turns decline into disaster. When investors borrow money to buy stocks, falling prices force brokers to demand more cash. If that cash isn't available, brokers liquidate holdings, driving prices lower, which triggers more margin calls, more liquidations, and total collapse. That exact cycle destroyed markets in 1929, and margin debt today sits near the same levels as that doomed era. Institutional funds make things worse. When markets drop beyond certain thresholds, automated systems sell billions instantly, not out of emotion, but because risk rules demand it. The result, a mechanical avalanche of selling. Within weeks, the market could fall 30 to 40%, fueled by margin debt, panic selling, and algorithmic trading. But the chaos won't stay in stocks. Investors will flee to safe U.S. bonds, just as the Treasury tries to sell trillions more to cover deficits. Too much supply, not enough buyers. Interest rates surge even higher. That's the doom loop. Higher rates make debt more expensive. More debt means more borrowing. More borrowing pushes rates higher again. Countries caught in this cycle don't escape. They either default or inflate their currency into worthlessness. Then the housing market freezes. Buyers vanish, sellers hold out, and homes sit unsold for months. Eventually, desperate owners cut prices, setting new, lower benchmarks that pull everyone's property values down. Within 6 months, prices could drop 20 to 30%, and in overheated cities like Austin, Phoenix, Boise, and parts of California and Florida, even 50% declines are possible. Homeowners who bought recently will owe more than their properties are worth. Commercial properties suffer the same fate. Landlords can't refinance, so they stop paying and hand the keys to the bank. Those buildings are now worth half their loan value, creating catastrophic losses. Banks with too many of these loans will see their capital wiped out. When that happens, regulators close them, just like they did to 465 banks after 2008. This time, it could happen faster and hit harder. Bank failures fuel bank runs. Fear spreads even to healthy institutions. Customers rush to withdraw money, forcing banks to sell assets at fire sale prices, deepening losses. Even solvent banks become insolvent overnight. The FDIC, with its $125 billion fund, can't handle multiple large failures. A government will be forced to print money, reigniting inflation and crushing the dollar's value. Meanwhile, unemployment skyrockets. As demand collapses, businesses slash costs. Tech firms shed 10 to 20% of workers. Finance and retail follow. Within months, joblessness jumps from 4% to 8% and could exceed 12 to 15% within a year. Depression-level unemployment. The Federal Reserve then faces an impossible choice. Cut rates and risk runaway inflation, or do nothing and let the economy implode. Every option leads to pain. In 2008, rate cuts and quantitative easing saved the system. In 2025, those same tools will destroy it, because inflation never truly left. Retirement savings collapse. A worker with $600,000 in a 401k could see it fall to $200,000 or less. 30 years of effort gone. For retirees relying on portfolio withdrawals, it's worse. They'll be forced to sell at the bottom, locking in losses forever. The mental toll will rival the financial one. In 2008, most portfolios recovered in 5 years. This time, recovery could take decades, if it happens at all. Just look at Japan. Its stock market took 34 years to reclaim 1990 highs. Young people entering the job market in 2026 to 27 will face a barren landscape. No openings, record competition, and years of lost income potential. Small businesses, restaurants, shops, service firms will collapse by the hundreds of thousands. Only the biggest corporations will survive, further concentrating power and reducing innovation. As unemployment soars, government aid programs will buckle. Tax revenue plummets while welfare demand explodes. Cuts become inevitable. Social and humanitarian crises emerge, with millions of elderly, disabled, and unemployed left with minimal support. Economic pain breeds political chaos. History shows that when people lose everything, they seek someone to blame. Just as the Great Depression gave rise to extremism in the 1930s, a modern collapse could ignite populism, division, and instability in America. The political landscape of 2026 could look nothing like today's. Why is 2025 likely to be worse than 1929 or 2008? because it combines all three crises in one. The stock bubble of 1929, the debt bubble of 2008, and a new government debt bubble unprecedented in history. In 1929, only 10% of Americans held stocks. In 2008, the government could print its way out. In 2025, everything, stocks, housing, bonds, and the dollar, will fall together, and there's no tool left to save them. The U.S. now carries $36 trillion in debt. Inflation is still high, and every warning light, yield curve inversion, insider selling, rising defaults, flashes red. History says recession hits 3 to 12 months after the curve normalizes. That points squarely to 2025 to 2026. When the cascade starts, it will be unstoppable. This isn't a prediction. It's pattern recognition. The same sequence that destroyed empires, crashed markets, and ended prosperity before is repeating again. Stocks could fall 65 to 80%, bonds 35 to 50%, real estate 40 to 60%, and unemployment over 15%. And unlike before, recovery could take a generation. The everything bubble earned its name because this time, everything goes down together, and there's nowhere left to hide. What history books call once in a century may now happen in our lifetime. The math doesn't lie. Too much debt, too little real value. The crash isn't coming. It's already on the way. To understand what's coming next, we can look back at the last great collapse, 2008. That crisis began with subprime mortgages, loans given to people who couldn't afford them. Those loans were bundled into complex securities and sold worldwide as safe investments. When home prices stopped rising, refinancing dried up, and defaults exploded. Banks holding mountains of worthless mortgage-backed assets started to crumble. Lehman Brothers collapsed in September 2008, a single domino that triggered global panic. Now, in 2025, the same danger exists, just under different names. We still have subprime lending, only this time it hides inside auto loans, credit cards, and corporate debt. Millions of Americans owe on 84-month car loans at sky-high interest rates. Credit card debt has shattered all records, with rates above 21%. Student loans now stand at $1.77 trillion, and few will ever be repaid. And corporations? They've borrowed over $10 trillion, 5 times more than in 2008, much of it used for stock buybacks instead of growth. In 2008, leverage was centered in housing. In 2025, it's everywhere, spread across every corner of the economy. The global derivatives market exceeds $600 trillion, 10 times the world's GDP. A small shock, a few major defaults or big rate swings could unleash a cascade of failures no one can stop. Back then, the Federal Reserve had tools. Interest rates were 5.25%, giving them room to cut to zero. They launched quantitative easing, printing trillions to stabilize the system. The Fed's balance sheet ballooned from $800 billion to $4 trillion. It worked, temporarily. But the price was massive money printing and bubbles that haunt us today. Now, rates are already low. Inflation just cooled after years of pain, and the Fed is trapped. Cut too much, inflation roars back. Refuse to cut, and the economy falls into depression. Either path leads to destruction. And the government? In 2008, debt was 67% of GDP. There was room to borrow and bail out. By 2025, it's 125%. Deficits run over $1 trillion a year. There's simply no capacity for another multi-trillion-dollar rescue. If Washington tries, bond markets revolt, interest rates spike, and debt spirals out of control. Meanwhile, China, the engine that once helped pull the world out of recession, now faces its own implosion. A real estate crash, aging population, and $13 trillion in local debt. Europe struggles with energy costs, demographic decline, and political disunity. When the next crisis hits, no nation will lead recovery. Each will fight for itself. And the warning signs are already flashing red. The yield curve, history's most reliable recession predictor, inverted in 2022, normalized in 2024, and now points to a downturn in 2025. Every time this has happened, a recession followed, without fail. Consumers are maxed out. Credit card balances now top $1.14 trillion, with delinquencies climbing fast. When households stop spending, 2/3 of the U.S. economy freezes. Commercial real estate adds another ticking bomb. $2 trillion in loans must be refinanced at double the interest rates. And buildings that once broke, even now bleed cash. Defaults are inevitable, and regional banks will take the hit, just as we saw in 2023 with Silicon Valley Bank, Signature, and First Republic. The FDIC's $125 billion fund would vanish within weeks of mass failures, forcing the government to print again, destroying the dollar's value further. And on Wall Street, the danger is concentrated in just 7 giants: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, the Magnificent Seven, holding 30% of the S&P 500 as value. If anyone falters, the whole market cracks. Nvidia alone could trigger a collapse if AI hype fades or earnings disappoint. Insiders see it coming. Bezos, Zuckerberg, and top Nvidia executives are selling billions in stock. Even Warren Buffett is sitting on a record $325 billion in cash, selling stocks and waiting for prices to fall. His own metric, the Buffett indicator, flashes 185%, far beyond the danger zone. Unemployment is rising. Auto and student loan delinquencies are surging, and the foundation of consumer credit is crumbling. Add ongoing wars, China-Taiwan tension, and oil supply shocks, and we re-looking at the most fragile global setup since the 1970s. The next collapse isn't just possible. It's already baked in. The question is not if, but when.